Morning, everyone. Thanks for taking the time. We're excited to be here. Myself and Cody Chandraw, the principals at the Healing Realty Trust, are excited to present with you our opportunity. Cody, good morning. How are you today?
I'm amazing. I'm sorry that you guys can't see me on camera. Got ready for you.
I'm sure it's a good thing for them, Cody. So, well, thanks, everyone. We're going to dive right in. Thank you to Wiz for having us on here. We're excited to present the Healing Realty Trust. So the Healing Realty Trust is a triple net lease strategy that is focused on the behavioral, mental, and physical health space. This opportunity is for qualified investors. We are raising capital to go out and purchase real estate. That's the baseline business that we're in. We are a real estate company that is designed to purchase and lease real estate in the behavioral health sector. This health sector is gigantic. It's about 165 billion by 2030. As you all know, and I think as we all can believe, that the health sector in America is underserviced, certainly from the real estate side. We think that there is an incredible opportunity on sub-institutional properties, so properties below $15 million, where we can come in, acquire real estate, lease it back to operators, and really expand a portfolio that ultimately creates disproportionate yield for our investors. We've put together an amazing team that we'll talk about that has an incredible depth of knowledge, not only in real estate, finance, but also in the health and wellness sectors. The nice thing about this industry, healthcare is typically a counter-cyclical industry. So meaning as we hit more and more financial headwinds and recessionary indicators, this sector should actually outperform. It will do very well in what we would all consider a traditional down market. So it's a great place to park cash. It's a great place to still earn outsized yields, and be a part of a growing sector. So as we dig into this, the health and the wellness and healing sector is about a $9 trillion industry, or heading that way. The behavioral health sector is about 160 billion by 2030. And then where we're also going to be focusing is on the psychedelic therapy side, where we think a lot of the new medicines are going to come out of the psychedelic industry, especially in the mental health space, whether that is PTSD related, whether that is step-down therapy from a drug or alcohol addiction, or all of the different opportunities that are being developed. As we look at these sections on page 4, the health and the wellness and healing sector is a very competitive subset. So what that means is there's billions and billions of dollars in REIT or real estate opportunities that go out and focus on that. When you have a lot of people looking into specific sectors and providing capital to those sectors, the interest rates or the rents that those companies are paying go smaller and smaller because they have a depth of opportunity. As you move to the right and move into behavioral health, there are less funds focused on that sector. So the rents that they're willing to pay are a little bit higher. And then last, as you move into the psychedelic therapy, most real estate opportunity funds will not even touch that space yet. Even though the therapies we're talking about are federally legal, many funds are not designed, or they don't understand that sector, so they shy away from it. So again, as we move from left to right in this, we expect higher rents from tenants, which ultimately is what drives the yields for us and our investors. So our focus is really on this third bucket. However, we will be working in any aspect of the medical space, meaning we will do hospitals, we will do rehab facilities, we will do sports medicine centers, substance abuse clinics, you name it, we will deploy capital into those various markets. But where we think we will get outsized returns is as we focus more on the new therapies, especially in psychedelic assisted therapies, as those become more and more available. In addition, all of the types of tenants we're looking at do a majority of their business through healthcare reimbursement. So meaning their insurance is reimbursing tenants, or I'm sorry, reimbursing customers or patients for their services. This is a big part of our underwriting methodology. If we know that the customer is going to be paying the operator, we know that our rent will get paid, which is ultimately what this strategy is all about, is making sure we get outsized returns, making sure we have quality tenants in there, and making sure that that money flows in and flows out to our investors in as quick a period of time as possible. The team that's put together, myself, Joe Caltabiano, I sit as CEO. I'm very excited about this opportunity. I'll give you a little background on myself and Cody and some of the other key members of the team. My background was in finance. I was in the mortgage banking space starting in 2000. I helped develop one of America's largest real estate finance companies called Guaranteed Rate. I was one of the top loan originators in the country, and I built that company up from a few $billion a year to one of the largest lenders in the nation. When I was there, we focused on not only residential, but the commercial space. This is really where I cut my teeth on the lending side, understanding credit and such. In 2013, I formed a company called Cresco Labs. Cresco Labs is a leading cannabis operator. We were a vertical company. We were focused on cannabis operations within the United States, not only on the grow, manufacturing, and retail side, but we also launched a real estate company under that platform that owned and managed our own real estate. So as I went out and developed a few million square feet of real estate, we serviced that ourselves, we managed those properties ourselves. In addition, I was able to scale that up to meet the growing demand of Cresco Labs as we went from 1 state to 12 states. In that time, it was very difficult to structure financing in the real estate space in cannabis. I was able to go out and find debt. I was able to go out and find deals that helped us grow that over a very short period of time in probably the most difficult headwinds I've ever been a part of, meaning a federally illegal industry, very little banking, very little knowledge of the space, and we were able to obviously put together a great real estate portfolio under that company. Subsequent to that, I launched another venture fund, was able to raise a significant amount of capital, and I was kind of content not working as hard anymore. I was approached by Cody and Dan Carcillo, who had been investing in the psychedelic space. Cody at his fund, Umbria Capital, has participated in the growing industry of psychedelics since pretty much its inception. He's deployed over $30 million into the space, into over 50 investments, writing over 120 checks into those various investments. He's seen that industry from its infancy to its growing pace today. In addition, he's invested in all aspects of that business, meaning from drug development to operating clinics to all points in between. Cody has had a front row seat at this industry. So that gives us incredible insights as we're going out and talking to operators. The ability for us to communicate with them, understand their business, helps us make them the ideal landlord. And when you have a strong landlord, it gives that tenant the opportunity not only to run their business and focus on their business, but it also gives them the ability to scale and the comfort to scale, that they know you're there as a real estate partner along the way. In addition to Cody, David Kivitz, who heads up our real estate, has been involved in the real estate and finance market since a very early age. He currently is CEO of Excess Financial, which is the largest equipment and finance company in the cannabis sector. They've deployed over $150 million in the space. They've had 0 defaults. So when you look at a real estate investment, you want to understand that the opportunity size is there, that the team you're talking to not only can go out and get clients, but they also have the understanding of credit and making sure that the customers they're deploying capital to are the right ones who are ultimately going to be paying for the long term. So as you're betting on real estate, you're signing 10, 15-year leases with these operators. So it's critically important that they are able to repay the lease that they're signing on to. David has been an expert in that, not only in the cannabis space, but prior to that, running a fund called Verde, which acquired and developed a huge portfolio of real estate throughout the United States. He took a very small amount of capital and leveraged it up to generating over $250 million for real estate developments. Why does this matter? So as we go out and raise capital, we want to put together the most efficient acquisition process the industry has seen. We want to identify the right deals, we want to identify the right customers and deploy the capital appropriately. Anyone can go out and buy real estate. It's buying real estate right that is critically important. And as we look at the commercial real estate market today, there are great indicators showing decline in property values. It doesn't mean that the properties are not good. It just means there's less access to capital for a lot of people. So it becomes what's known as a buyer's market. Buying property right is how you make money in real estate. So I think we're approaching this at the opportune time to find real deals and real value where we can purchase properties, again, under $15 million with strong operating tenants who've been in business for many, many years, who are looking at adding new therapies to increase their revenue, who also have had a great track record of working with insurance companies, again, assuring that payments come in and thus making sure that they're able to pay rent. As we look at these properties, the first thing we look at is qualifying the tenant. How many years have they been in business? What does their capital position look like? Then we try to understand where they're going from there. When you're underwriting credit, you're always looking backwards, but we also want to make sure we find people who want to grow their business. This isn't the last stage in the game for them. This is the first stage of what we hope to be as a growing business. As we look at the real estate and acquisition process, some of the things you want to note, especially early on in our financing, we will be doing properties that are already tenanted. So meaning we're not going out and looking for tenants. We have people out there who are coming to us. All of the acquisitions that we've sourced thus far have been inbound, meaning as we've put announcements out there to saying we're going out to buy properties and lease them back to operators, we have been inundated with over $100 million in interest that we're currently underwriting. So these deals are typically up to $15 million, lease terms ranging from 10 to 30 years. It's a triple net lease, so meaning they pay not only the rent, but then all of the taxes and insurance and maintenance of those properties. We will be looking at a minimum cap rate of 9%, which in years past, some of these properties would have had much lower cap rates, thus making purchase prices more expensive and yield a return to investors much lower. The minimum we will look at is 9%. The target that we're looking at is well over 10 plus. We will do a little bit of tenant improvements to make sure we're customizing these properties for operators for the long term. They have to have been in business for 3 years. They have to have had $3 million in trailing revenue. We expect strong margins from this sector. We are not in a business who is going to go out and work on new ventures. We are looking for existing operators who own their real estate and are looking to unlock the capital to go out and grow their business further. Those are our ideal tenants. We will have a strong security interest. We will look for corporate guarantees. We will make sure we have the right security on the properties. One of the notes I should mention on David and David Kivitz's company Excess is while they've deployed $150 million, they've had 0 defaults in the cannabis industry, which is, again, unheard of. So we will really focus on the credit and underwriting process to make sure we're buying the right properties and putting the right tenants in place. The foundation of this business is really designed to also look at outsized returns of emerging therapies. So while we are looking for existing operators who've been in business and they may be an eating disorder clinic, but what they're recognizing is many of the therapies that they're providing or many of their patients also have underlying issues that aren't getting treated for just the eating disorder, meaning 20% of people in eating disorder clinics also have a PTSD diagnosis. So as these new therapies and psychedelic therapies especially come into play, we will see an opportunity for them to add other lines of business, thus increasing their revenue, thus making them stronger tenants. With that, I'm going to turn it over to Cody to talk about the underserved market that we're looking at.
Thanks, Joe. So guys, I know a lot of you know me already. I've spoken with, I don't know, probably 24 of you. I appreciate the time. You guys know I've been at the tip of the spear here on the psychedelic side. One of the reasons why we started this company is the capital that is going to come into this space and what has already come into this space is lacking, to say the least, in here. So when you're looking at most REITs, they're looking at asset classes that are over that $15 million mark. And that's one of the reasons why we decided to focus here. We're going to cover in this next slide a little bit more in depth as to why this opportunity makes the most sense. So if you look here, $2.7 billion has been invested into the psychedelic therapy space over the last 36 months. And why is that important? Because as these new drugs come online, You see on the right-hand side, on the upper right-hand corner of this page, only $250 million has actually gone into the infrastructure where these medicines are going to be delivered. So it's created a giant shortfall and bottleneck where this is going to be that big advantage that Joe talked about. Listen, the traditional opportunities are there for us, but this is the special sauce that is going to make us this big player in this space. If you go to the bottom of the page, you'll see down there, we're focusing on sale leasebacks of existing centers. So what does that mean? These are tenants that have already been inside of the building. As Joe mentioned, the credit underwriting is a very large portion of what we do. We want to focus on operators that have been practicing medicine for years. So what does that mean for us and for you as an investors? As soon as this new therapy is approved, specifically MDMA right now, but obviously as most people on this call knows, psilocybin's coming down the road very shortly, ketamine is already approved. This is going to allow us to take these existing facilities and just convert the existing space to accommodate these long duration treatments. You have to remember, the clinical infrastructure that's currently set up is you get a prescription, you go to your doctor, they send you to Walgreens, CVS, Walmart, wherever you pick up your medicine at, and that's it. That lives on your counter in your bathroom or your kitchen, wherever the case may be, and you take that pill. This is a lot different, right? Because you're going into a clinic anywhere from 4 to 8 hours for these treatments. So what does that mean for our tenants? Listen, they all want to add these. Obviously, this is another tool in the toolbox for them to help treat their patients, but what that does for us is this now makes them a more profitable tenant. And what does a more profitable tenant do? They want to open up additional locations, and they're a better paying tenant. So, for us, it works out multiple ways. And, we're not reinventing the wheel here. It's one of the things I really want to focus on. We've seen this happen. Obviously, when dialysis came on the scene, that was all done in hospital. But now there's over 10,000 dialysis clinics in the United States. In urgent care, I mean, look around your neighborhood, right? 11,900 urgent care facilities have been opened up in the last 5 years alone. That industry is growing at a 10% CAGR. So, this isn't something that is brand new. We're just kind of pushing this along a little bit faster. So strategic relationships, maybe one of the most important things that we focused on here is having a very solid pipeline of opportunities. And as Joe mentioned, we've done no outbound marketing. Through our relationships with Blueprint and CBRE, we have been provided an incredible amount of well-qualified tenants. And then if you look in the middle of the page on the bottom here, the clinic licensing platform. So we talked about, taking these existing facilities and adding on. Obviously, a lot of these people are not going to have that really innate niche focus for their clinic. So our partnership with Numinous allows a turnkey program for these doctors to add these new therapies, new training methods, and their practitioners to offer these therapies for their clients. And proprietary data with healing maps. We're going to cover that on the next slide. This is one of my favorite things about this company. So what you're looking at is Denver. We had a tenant, okay, that was operating a very successful practice right along the western side. So if you look at Golden, that gray and black dot on that left side there, that's where his practice is. So he's actually less than a half a mile away from a VA clinic. And what he does is all behavioral health, right now mainly focusing on addiction issues. But his business is dependent on those referrals coming from that VA hospital. So he wants to be very closely located to these existing VA centers. So as he reached out to us, he wanted to be in downtown Denver. We were able to show him this map and this tool that we've created, which aggregates over 800,000 points of data to look and say, Doc, listen, we understand this is where you want to be, but let us show you where you should be. So if you look at Lakewood, South Lakewood, you see that VA facility right there. there's nothing within a 15-mile radius of that facility. So we were able to take him where he was looking downtown Denver, and now not only is he closer to his first office, but we're able to put him in a location where he has no competition. So he is the only doctor in that area. So the VA was very happy to send him all of the patients that they're dealing with for PTSD. Now we're looking at a center in Northwest Aurora for him where there is, again, no competition. So being able to integrate that behavioral health data that we have of not only what the current clinical infrastructure looks like, but also where these areas are most affected gives us a giant competitive advantage.
So as we look at, thanks, Cody. So as we mentioned, this has been a full inbound opportunity for us thus far, meaning as we put out the news that we've launched the Healing Realty Trust and we're out buying properties to lease them back to operators, we've been inundated with opportunities. So this is a quick pipeline of some of the deals we're looking at. And as you can see, the important characters, again, are typically, they're under $15 million. So there's less of a competition. It's all in the behavioral, mental, and physical health space. And then the cap rate. So the return we're expecting on this money is considerable. If you were to go out and do a traditional REIT today, you're looking at cap rates in the 6-7% range, and depending on the specialty, maybe a little higher, maybe a little lower. Healthcare is an incredibly well-performing asset class. Typically, you're not able to get these type of yields in the healthcare space. It's just a very unique time with a shortage of capital, a huge opportunity. So as we are getting so many inbounds, it's great for us because then we can make sure we underwrite these tenants to our fullest capability to make sure we're putting the right people in place, that we're deploying the capital that we have to create the highest return for our shareholders. As we look at the uses, this kind of gives you a quick snapshot on a couple deals that we're looking at. The founders have all put money into this. So one of the questions, I've been on the investing side for many, many years, and typically my first question is, how much money have you guys put in? So the founders, myself, Cody, and all of the other people who were involved have put their hard-earned capital into this to sit right next to yours. We're now launching a $25 million funding round to go out and start to acquire these properties. We expect to deploy this capital very quickly. Following on that, once we raise this $25 million, we will be immediately launching a subsequent round with $50 million on the institutional side. So we have Piper Sandler, who we're very excited about, leading our institutional round, which will come subsequent to this round. So this is your opportunity to come in as investors, and that's not usually the way real estate works. It usually is led by founders capital, then institutional money, and then individuals and high net worth and family offices come in. So we're giving the opportunity right now to launch this to you, the investors who are out there, to get in front of the institutional capital. We think that's a very unique proposition. We think it will give us the momentum not only to go out and acquire properties in a short period of time, but then also make sure that we maximize the opportunity with the institutional investors. Financial projections, and this is always difficult to kind of present to people. As you have questions on this, we certainly can set up some follow-ups, but this kind of gives you a quick snapshot of our projections for the forthcoming years. We expect 2024 to be our first build-up year. We expect to acquire a couple properties a month and build up in excess of $8 million, close to $9 million in top-line revenue. You're going to see the returns and the dividends that we pay out to be substantial. We expect to add some leverage onto this to also create outsized returns, meaning we will be able to, and we have found debt partners who want to participate with us. The portfolio, we're expecting somewhere around 55% leverage, again, to drive outsized returns to our investors. Again, you're getting in at this is the first raise that we've done outside of the founders. So you're really getting in at that first floor level, creating a huge opportunity and what we expect to be a big upside for you as the investors. In closing, I want to point out to you kind of just the highlights one more time. We see this opportunity as massive. $165 billion in the healthcare and behavioral health market by 2030. We think that the psychedelic industry will grow from $4.5 billion to closer to 15 to 20 billion by the time we hit 2031. So the opportunity is there. The yields we're talking about are substantial. The team that we've put together not only understands the various nuances of health and wellness, but it understands real estate, it understands credit, it understands finance, and it has a proven track record of delivering outsized returns to its investors. We all know that the economy today is facing some significant headwinds, but we also know that the healthcare real estate sector, again, is counter-cyclical. This should be a recession-resistant sector that will have a buffer in your portfolio that is still creating returns and creating yields for you, even as some of the other asset classes might face some significant headwinds. The team is well-versed to go out and find the right tenants, to deploy the capital appropriately, and to scale this to over $1 billion in assets under management within the next 5 years. So again, thank you very much for your time. Speaking for myself and Cody, we're really excited to present this opportunity and happy to answer any questions as this goes forward. Thank you very much for your time. Everyone, we appreciate your time. Thank you so much for listening to us, and we look forward to answering any questions you may have in the future.
Is there a section for questions?